There's a mechanism hidden inside the Federal Reserve's operating system that has triggered every major market collapse in the last 100 years. And 1 minute ago, they just activated it again. In 1929, the Fed raised interest rates to cool speculation. Within months, the stock market lost 89% of its value, and the Great Depression began. In 2000, the Fed raised rates to fight inflation. The dot-com bubble collapsed. $5 trillion in market value evaporated. Retirement accounts destroyed. In 2007, the Fed kept rates too low for too long, then raised them too fast. The housing market imploded. The financial system nearly died. Lehman Brothers collapsed. Bear Stearns vanished. The global economy entered the worst crisis since the 1930s. 3 times, 3 different decades, 3 complete market collapses, all triggered by the same mechanism. And here's what should terrify you. The Federal Reserve just activated that exact mechanism again. Right now, today, this isn't prediction. This is observation. The countdown has started and most investors have no idea what's coming. This is the story of how the Fed destroys markets, why they always claim they didn't see it coming, and why the pattern says we're about to experience the worst crash in modern history. And the warning signs are everywhere for those willing to see them. Welcome to Boring Economy, the only channel that gives you the truth about markets without the Wall Street propaganda. Listen, I know you're tired of financial news that treats you like you're stupid. You're not here for hype. You're here for reality. You want to understand what's actually happening to your money, your investments, your future. If that's you, if you value honest analysis over comfortable lies, hit that subscribe button right now. Smash that like button, because the information in this video could save you from financial destruction. And make sure you're subscribed, because when this market collapse goes mainstream, when everyone's panicking and asking what happened, you'll already know. You'll have been prepared. Now, let's talk about what the Fed just did and why it changes everything. 1 minute ago, in the most recent Federal Reserve policy statement, they confirmed something that should make every investor's blood run cold. They're keeping interest rates elevated despite clear signs of economic weakness. They're maintaining restrictive monetary policy even as cracks appear throughout the system. They're doing exactly what they did before every major crash in history. And they're doing it with the same confidence, the same certainty, the same arrogance that they had in 1929, in 2000, in 2007, right before everything collapsed. The Federal Reserve operates the most powerful financial weapon in human history, the ability to control the price of money itself. When they raise interest rates, borrowing becomes expensive. Businesses cut back, consumers stop spending, asset prices fall. When they lower rates, borrowing becomes cheap. Businesses expand, consumers spend, asset prices rise. This power to expand or contract the entire economy gives them godlike control over markets, and throughout history, they've used that power to create disaster after disaster after disaster. Because the people running the Fed aren't evil, they're just wrong, consistently, predictably, catastrophically wrong. Before we talk about what's happening right now, you need to understand how this pattern has played out before. Not once, not twice. 3 times in the last century, the Federal Reserve has triggered complete market collapse using the exact same playbook. Let me show you what happened and why the pattern is repeating right now. In 1927, the American economy was booming. The roaring 20s, stock prices rising every month, new technologies transforming society, cars, radios, electricity spreading across the country, wealth being created at unprecedented rates. The stock market had tripled in 5 years. Everyone believed prosperity was permanent. The business cycle had been conquered, economic depressions were things of the past, and the Federal Reserve, led by Chairman Roy Young, believed they had perfected monetary policy. They had the tools, they had the knowledge, they could manage the economy with scientific precision. But beneath the prosperity, dangerous imbalances were forming. Stock speculation had reached manic levels. People were borrowing money to buy stocks, buying more stocks with the profits, borrowing even more. Leverage was everywhere. Margin debt at record highs, the entire market built on borrowed money and borrowed time. Stage 1 was monetary expansion. The Fed had kept interest rates extremely low throughout the mid-1920s. Money was cheap, credit was easy, banks were lending to anyone. This cheap money flooded into the stock market. It inflated asset prices far beyond any rational valuation. Companies trading at 30, 40, 50 times earnings, stock prices completely disconnected from underlying business fundamentals. The Fed saw the speculation, they saw the danger, but they believed they could control it with precision adjustments, small, careful, scientific interventions. Stage 2 was the rate hike cycle. In 1928, the Fed started raising interest rates to cool the speculation. Small increases. At first, a quarter point here, half a point there. The market stumbled but recovered. So they raised rates again and again. By 1929, rates had doubled from their lows. The Fed believed they were engineering a soft landing, a gentle cooling of speculation, without triggering a crash. They were wrong. Stage 3 was the credit contraction. Higher interest rates meant borrowing became expensive. Margin loans that fueled stock speculation suddenly cost twice as much to service. Over-leveraged investors couldn't afford the payments. They had to sell stocks to raise cash. And when selling started, it fed on itself. Stock prices fell, margin calls went out. Forced selling accelerated, prices fell further, more margin calls. More forced selling, the spiral had begun. Stage 4 was the crash, October 24, 1929. Black Thursday. The stock market opened and immediately collapsed. Selling pressure so intense that the ticker tape couldn't keep up. Prices falling so fast that investors didn't know what their stocks were worth. By the time markets closed, billions of dollars had evaporated, but the Fed still believed they could control it. They thought it was a temporary panic, a market correction, nothing that would affect the real economy. They were catastrophically wrong. By 1932, the stock market had fallen 89% from its peak. 89%. Almost complete destruction of wealth. Banks failed by the thousands. Businesses collapsed. Unemployment reached 25%. The Great Depression had begun, and it lasted for a decade. An entire generation scarred by economic trauma that shaped American policy for 50 years. The Federal Reserve, the institution created to prevent financial panics, had triggered the worst financial panic in history. And their response? They claimed nobody could have seen it coming. They said the crash was caused by irrational speculation, not their policies. They denied responsibility, exactly like they always do. Now let's jump forward 70 years. In 1998, the American economy was booming again. The internet revolution, the new economy. Technology companies transforming business, communication, society itself. Stock prices rising every month. The Nasdaq Composite had tripled in 3 years. Companies with no revenue trading at billion-dollar valuations. Everyone believed this time was different. The old rules didn't apply. Profits didn't matter. Growth was everything. And the Federal Reserve, led by Chairman Alan Greenspan, believed they had perfected monetary policy. Greenspan was called the maestro and the greatest central banker in history, the man who had conquered the business cycle. He had the tools. He had the wisdom. He could manage the economy with scientific precision. Sound familiar? Stage 1 was monetary expansion. The Fed had kept interest rates low through the late 1990s. The economy was growing. Inflation seemed contained. There was no reason to raise rates. This cheap money flooded into technology stocks. It inflated the dot-com bubble to absurd levels. Pets.com, .webvan, e-toys. Companies burning cash, losing money every quarter, but trading at valuations that assumed they would dominate the world. Stock prices completely disconnected from reality. Stage 2 was the rate hike cycle. In 1999, the Fed started raising interest rates to prevent inflation. Small increases at first, a quarter point, then another, then another. By 2000, rates had risen from 4 3/4% to 6.5%. The Fed believed they were managing inflation without harming the economy, engineering another soft landing. They were wrong. Stage 3 was the credit contraction. Higher interest rates meant venture capital became harder to get. Technology companies that depended on constant funding suddenly couldn't raise money. They had no profits, no path to profitability, and now no access to capital. They started failing one by one, then dozens, then hundreds. The Nasdaq peaked in March 2000, began falling, slowly at first, then faster, then catastrophic. Stage 4 was the crash. By 2002, the Nasdaq had fallen 78% from its peak. 78%. $5 trillion in market value destroyed, retirement accounts cut in half, college savings evaporated, millions of investors financially devastated, the dot-com bubble had burst, and the Federal Reserve claimed they couldn't have predicted it. They said asset bubbles are impossible to identify in real time. They denied their rate hikes had caused the crash. They blamed irrational exuberance, exactly like they did in 1929. The same pattern played out again just 7 years later. In 2006, the American economy was booming once more. The housing market was on fire, home prices rising 20% per year in some markets. Everyone flipping houses, everyone getting rich on real estate, no money down mortgages, subprime loans to anyone with a pulse, ninjas, no income, no job, no assets, and they were getting approved for $500,000 mortgages. The financial system had created mortgage-backed securities, collateralized debt obligations, synthetic CDOs, weapons of mass financial destruction that even the people selling them didn't understand. And the Federal Reserve, led by Chairman Alan Greenspan and then Ben Bernanke, believed they had everything under control. They saw the housing bubble, they saw the dangerous lending, but they believed the market would self-correct. They believed the financial system was resilient. They believed they could manage any problems that emerged. Stage one was monetary expansion. After the dot-com crash, the Fed had slashed interest rates to 1%, the lowest in 50 years. They kept rates there for years. This created the cheapest money in history. It flooded into housing. It created the largest asset bubble the world had ever seen. Home prices in some cities tripled in 5 years. People with no income buying million-dollar homes. The entire system built on the assumption that home prices would rise forever. Stage two was the rate hike cycle. In 2004, the Fed started raising rates to prevent inflation. 17 consecutive rate hikes from 1% to 5.25%. The fastest tightening cycle in decades. The Fed believed they were normalizing policy to removing accommodation, managing the economy back to sustainable growth. They were creating a time bomb. Stage three was the credit contraction. Higher interest rates meant adjustable rate mortgages reset higher. Subprime borrowers who could barely afford their payments suddenly faced double the monthly cost. They defaulted by the millions. Foreclosures exploded, home prices started falling, and the entire financial system discovered it was built on worthless assets. Mortgage-backed securities became toxic. Banks holding billions in these securities became insolvent overnight. Bear Stearns collapsed in March 2008. Lehman Brothers collapsed in September. The financial system froze completely. Credit markets shut down. The global economy entered freefall. Stage four was the crash. The stock market fell 57% from peak to trough. 57%, trillions destroyed. Retirement accounts devastated. The worst financial crisis since the Great Depression. And once again, the Federal Reserve claimed they didn't see it coming. Ben Bernanke said in 2007 that subprime problems were contained. They weren't. The Fed denied their policies, created the bubble. They blamed greedy bankers, predatory lenders, irrational borrowers, everyone except themselves. 3 crashes, 1929, 2000, 2008, 3 complete market collapse, all following the exact same pattern. Monetary expansion, creating a bubble, rate hikes popping the bubble, credit contraction, triggering forced selling, market crash, destroying wealth. And every single time, the Fed claims they didn't see it coming. Every time, they deny responsibility. Every time, they blame everyone except themselves. Before we apply this pattern to today, you need to understand the actual mechanism that makes this happen, not the economics textbook version, the real version, the version that explains why Fed policy always ends in disaster. The Federal Reserve controls something called the federal funds rate. This is the interest rate banks charge each other for overnight loans, and this one rate affects everything else in the economy. Mortgage rates, car loans, credit card rates, business loans, everything. When the Fed lowers this rate, they're making money cheap. Banks can borrow cheaply, so they lend more. Businesses borrow to expand. Consumers borrow to spend. Asset prices rise because borrowed money flows into stocks, real estate, everything. This creates what feels like prosperity, rising markets, increasing wealth. Economic growth, but it's artificial, it's built on debt, it's unsustainable. When the Fed raises rates, the process reverses. Money becomes expensive, banks lend less, businesses cut back, consumers stop spending. And here's the critical part. All the assets that were purchased with borrowed money now have to be serviced with more expensive debt. Someone who bought stocks on margin at 2% interest suddenly faces 5% interest. Their carrying costs double. They can't afford it. They have to sell. Someone who bought a house with an adjustable rate mortgage sees their payment jump from $2,000 to $4,000 per month. They can't pay, they default, and the house goes into foreclosure. This is called forced selling. Not selling because you want to, selling because you have to, because the debt service became unaffordable, because margin calls went out, because the bank is foreclosing, because bankruptcy is the only option. And forced selling creates a death spiral. When people sell assets because they have to, prices fall. When prices fall, more people get margin calls, and more people default on loans. More people are forced to sell. This drives prices lower, which forces more selling, which drives prices lower. Still, the spiral feeds on itself. It accelerates. And once it begins, the Fed can't stop it. They can cut rates, they can inject liquidity, they can promise to support markets, but the selling doesn't stop until every over-leveraged position has been liquidated, until every bad loan is defaulted, until all the artificial wealth created by cheap money has been destroyed, This is the mechanism. This is how it actually works. And the Fed knows this. They know that when they create cheap money, it inflates asset bubbles. They know that when they raise rates, those bubbles pop. They know the pattern. They've seen it 3 times, but they keep doing it anyway. Because they believe each time is different. Each time they have better tools. Each time they're smarter than their predecessors. And each time they're wrong. Now let's talk about the United States in 2026 and why every warning sign is flashing red again. Let me show you exactly where we are in the pattern that has destroyed markets 3 times before. Stage 1, monetary expansion. Check. In 2020 and 2021, the Federal Reserve slashed interest rates to 0. They held them there for 2 years. They printed $5 trillion quantitative easing on a scale never seen in human history. They expanded the money supply by 40% in 24 months. This created the cheapest money in the history of the world. 0% interest rates, free money. It flooded into everything. Stocks hit all-time highs. Housing prices surged 30% in 2 years. Cryptocurrency exploded. Spaceys, meme stocks, NFTs, everything inflated simultaneously. The everything bubble, the largest asset bubble in human history, bigger than 1929, bigger than 2000, bigger than 2007, and it was created entirely by Federal Reserve policy. Just like the Roaring '20s bubble, just like the dot-com bubble, just like the housing bubble, check. Stage 2, the rate hike cycle, check. In March 2022, the Fed started raising rates to fight inflation. And 11 rate hikes in 18 months from 0% to 5.5%. The fastest tightening cycle in 40 years. Faster than 2007, the most aggressive monetary tightening in modern history. And just like every time before, the Fed claims they can engineer a soft landing. They claim they can cool inflation without triggering a recession. They claim they can deflate the bubble gently without causing a crash. They're using the exact same language they used in 1929. The exact same confidence they had in 2007, and they're going to be wrong again. Check. Stage 3, the credit contraction. Check. Higher interest rates are already destroying the economy. Regional banks collapsed in 2023. Silicon Valley Bank failed. Signature Bank failed. The First Republic failed. The 16th, 17th, and 18th largest bank failures in American history, all in a matter of weeks. These weren't small community banks. These were institutions with hundreds of billions in assets, and they failed because higher interest rates destroyed the value of their bond portfolios. They owned treasury bonds paying 2%. When rates rose to 5%, those bonds lost 30, 40, 50% of their value. The banks became insolvent overnight. The commercial real estate market is imploding in slow motion. Office buildings worth $500 million in 2021 are selling for $150 million today, a 70% loss. Because nobody wants office space anymore. Remote work destroyed demand, and higher interest rates destroyed financing. A building that could be financed at 3% might generate enough rent to cover the mortgage. The same building financed at 7% bleeds cash every month. Owners are walking away, handing keys to banks. Banks are foreclosing and discovering the properties are worth half what they loaned. Losses in the hundreds of billions are coming. Credit card debt hit $1 trillion for the first time in history. $1 trillion. And delinquencies are rising. People maxed out cards when money was cheap. Now interest rates are 25%. They can't afford the minimum payments. Defaults are accelerating. Auto loan defaults are spiking. People bought cars with cheap financing. Now they're underwater. They owe more than the car is worth. They can't afford the payments. Repos are surging. Corporate debt is the time bomb nobody's talking about. $23 trillion in corporate bonds outstanding. Much of it issued at 2, 3, 4% interest rates. All of it needs to be refinanced eventually, and when it does, companies will face 7, 8, 9% rates. A company with $10 billion in debt paying 3% interest pays $300 million per year, refinance at 8%, and that becomes $800 million. Where does that extra $500 million come from? It comes from layoffs, from cutting costs, from going bankrupt. The corporate debt refinancing crisis is just beginning, and it's going to destroy thousands of companies over the next 3 years. And the stock market, despite reaching new highs in some indexes, is being held up by just 7 companies: Apple, Microsoft, Google, Amazon, Meta, Tesla, Nvidia, the Magnificent Seven. These 7 stocks account for almost all the market gains of the past 2 years. Take them out, and the S&P 500 is down. The average stock is down 20% from its high. Small cap stocks are in a bear market. Most investors are already losing money, they just don't realize it because the indexes show green. But index performance is misleading. It's concentration, 7 stocks doing well, while 493 are struggling. The credit contraction is underway, the forced selling has begun. Most investors just don't see it yet. They think the regional bank crisis is over, they think commercial real estate problems are contained, they think corporate debt refinancing will work out fine. They're wrong. This is stage 3, and history shows that stage 3 always leads to stage 4. Check. We're at stage 3 of 4. 1,929 made it to stage 4 within months. The crash came fast. 2000 took about a year from stage 3 to complete collapse. 2007 took 18 months. We're in month 48 of this cycle. The rate hike started in March 2022. We're deeper into the pattern than we've ever been, and stage 4 is coming. Stage 4 is the crash, not a correction, not a bear market, a crash, a systemic collapse that wipes out trillions in wealth in weeks or months. The signs are everywhere. Market breadth is terrible. Most stocks are already down 20, 30, 40% from their highs. Only the Magnificent Seven are holding up indexes. Margin debt is at record highs. Retail investors are more leveraged than at any point in history. They're using options, using leverage, using borrowed money to buy stocks at all-time high valuations. Corporate debt is at record levels. $23 trillion. Companies that borrowed cheaply for years now face refinancing at triple the interest rate. Many won't survive. The commercial real estate market is collapsing in slow motion. $2 trillion in commercial mortgages need to be refinanced in the next 3 years. At current rates, they're underwater. Banks holding these loans face massive losses. And the Federal Reserve, despite seeing all of this, is keeping rates elevated. They're maintaining restrictive policy. They're doing exactly what they did before every crash. They're prioritizing inflation over financial stability. They're ignoring the warning signs. They're pretending everything is fine, just like 1929, just like 2000, just like 2007. When stage 4 hits, when the crash begins, it won't be gradual. History proves that. The 1929 crash took the market down 50% in 3 months. The 2000 crash destroyed 78% of the NASDAQ in 30 months. The 2008 crash erased 57% of the market in 18 months. This crash will be worse because the bubble is bigger, because the debt is larger, because the leverage is more extreme, because the artificial wealth created by 0% rates and $5 trillion in printed money is more massive than anything in history. You cannot keep interest rates at 0 for years without creating dangerous bubbles. You cannot print 40% of the money supply in 2 years without consequences. You cannot raise rates at the fastest pace in 40 years without triggering forced selling and defaults. You cannot maintain elevated rates while credit contracts without causing a crash. The sequence is locked in, the pattern is mathematical, the only question is exactly when stage 4 arrives. Maybe we have 6 months, maybe 3, maybe 6 weeks, but the Federal Reserve just confirmed they're keeping policy tight. They're ignoring the economic weakness, they're prioritizing inflation data over market stability. And that means the crash is coming sooner rather than later. Here's what people don't understand about Federal Reserve policy. The Fed doesn't prevent crashes. The Fed causes them. Every single time. They create cheap money that inflates bubbles. Then they raise rates to fight the inflation they created. Then they act surprised when the bubble pops. Then they cut rates again and restart the cycle. This has been the pattern for 100 years. Create bubble, pop bubble, deny responsibility, print money, create new bubble. The cycle never ends, and each bubble is bigger than the last. Each crash is more devastating. Each round of money printing is more extreme. In 1929, the Fed couldn't print money aggressively because the dollar was backed by gold. The crash led to the Great Depression, a depression that lasted a decade because the Fed couldn't just print unlimited amounts of currency. They were constrained by gold backing. In 2000, the Fed could print more freely. The dollar had been off the gold standard for decades. They cut rates to 1% after the crash. They flooded the system with liquidity. This created the housing bubble, bigger than the dot-com bubble, more dangerous, built on debt that ordinary Americans couldn't afford to repay. In 2008, the Fed printed trillions. They cut rates to 0. They did quantitative easing. They bought mortgage-backed securities. They bought treasury bonds. They expanded their balance sheet from $800 billion to $4.5 trillion. They did whatever it took to stop the bleeding, and it worked. They stopped the crash. They saved the banks. They prevented another Great Depression. But the cost was creating the everything bubble. the bubble we're in right now. And when this bubble crashes, when stage 4 arrives, the Fed will print again, they'll cut rates to zero again, they'll do quantitative easing again, they'll expand their balance sheet to 10 trillion, 15 trillion, whatever it takes, and they'll do whatever it takes to stop the bleeding. But this time, it might not work because the debt is too large. 36 trillion in government debt, 23 trillion in corporate debt, 12 trillion in consumer debt. The entire economy is drowning in debt. And there's a limit to how much more debt the system can absorb. Because inflation might stay elevated, the Fed printed 5 trillion during COVID, inflation hit 9%, the highest in 40 years. They got it back down to 3-4%, but it's sticky, and it's not going back to 2% easily. If they print another 5 trillion to stop the next crash, inflation might go to 15%, 20%. They might have to choose between stopping the crash and destroying the currency. And if they choose to print, if they choose to stop the crash at all costs, the dollar itself might collapse, because foreign creditors might not want to finance another round of money printing. China is already selling treasuries. Japan is reducing holdings. The BRICS nations are building alternative payment systems. The world is slowly, methodically moving away from the dollar. If the Fed prints trillions more, if they expand the balance sheet to 20 trillion, foreign central banks might accelerate that move. They might dump dollars in treasuries faster, and that would trigger a currency crisis on top of a market crash, because the tools that saved markets before might be broken this time. Zero interest rates don't stimulate when everyone is already drowning in debt. Quantitative easing doesn't work when bond markets are already saturated. You can't fix a debt problem with more debt. You can't fix a bubble problem by creating a bigger bubble. At some point, the tricks stop working, the magic fails, the system breaks, and we might be at that point right now. 3 times, the Federal Reserve has triggered complete market collapse using the exact same pattern. Cheap money creating bubbles, rate hikes popping bubbles, credit contraction forcing selling, market crash destroying wealth. 3 times, they've claimed they didn't see it coming. 3 times, they've denied responsibility. 3 times, they've blamed everyone except themselves. And right now, they're doing it again. The cheap money phase created the everything bubble. The rate hike phase is complete, the credit contraction is underway, and the crash phase is coming. The countdown has started. The pattern is repeating. The Federal Reserve just confirmed they're keeping policy tight despite clear economic weakness. And history says what happens next. The only question is whether you'll be prepared when it does. If this opened your eyes to what's actually happening, if this connected dots you hadn't seen before, you need to subscribe to this channel immediately. Hit that subscribe button right now. Smash that like button, because when stage 4 begins, when the crash that the Fed claims they didn't see coming actually starts, when trillions in wealth evaporate and everyone's asking what happened, you'll already know. You'll understand the pattern. You'll have been prepared. The Federal Reserve has triggered every major market collapse in the last 100 years using the exact same mechanism, and they just activated it again. 1 minute ago, the answers aren't hiding in some complex economic theory. They're written in history. In 1929, in 2000, in 2008, the pattern has been documented. The sequence has been proven, the mechanism has been tested 3 times, and every time the result was the same. Market collapse. Make sure you're subscribed because this story is about to get much worse, and you'll want to know what happens next.